Welcome back. Welcome back to the channel, Survive and Thrive. And today I'm here to talk about REITs, also known as real estate investment trusts. And the reason why I want to focus on those today is because they have a very good payback on your investment. And what I mean by that, if you look at this definition of REITs here on Google, to qualify as securities, REITs must pay out at least 90% of their net earnings to shareholders as dividends. And so this is one area of my portfolio that I haven't developed much, and I really want to focus on that in 2022, especially with all of the volatility and potential for a recession into the late Q3, Q4 of 2022 or moving into 2023. If anybody doesn't know about the company I want to focus on today, I want to do a quick summary. That company is Realty Income, ticker symbol O. And I know a lot of you have probably heard about this company, but just to give a quick summary, it's a real estate investment trust founded in 1969 as a public company. Their revenue in 2019 was $1.49 billion, with net income at $436 million as of that year. They are based out of San Diego, California. And let's take a look at their tenants. All very familiar names that we all know about. Walgreens at 6.1% of their 2019 revenue, 7-Eleven, Dollar General, FedEx, Dollar Tree, LA Fitness, AMC Theaters, Regal Cinemas, Walmart, and Sainsbury's. And you can see the respective percentage of their revenue. So these are anchor tenants that continue to pay them rental on the properties that they've acquired and continue to rent out to these very large companies. And so it's very stable. And they are one of the few REITs out there, or companies in general, that pay out a monthly dividend. So that's not very common, but it does give you very good security and payback on your investment. This Motley Fool author, Ruben Greg Brewer, writes about why Realty Income was one of his first stocks. Key points: he bought Realty Income decades ago because it had a 10% yield, which is very high for a dividend payout. He sold when the yield fell into the 4% range, which was a mistake. And now that he owns it again because of Realty Income acquisition, he doesn't plan to sell. In on the ground floor, over 2 decades ago, the REIT world was not as prominent as it is today in investors' minds. In fact, the sector was only just starting to be recognized as an important one. At the time, he worked as a mutual fund analyst, interviewing mutual fund managers and writing about what he learned. It was a great time for him, as he got to pick the brains of people putting money on the line in the market. One fund family he had the pleasure of talking to regularly was Cohen and Steers, among the first shops to focus on REITs. Now, this was a missed opportunity. He was so focused on the yield that he didn't pay close enough attention to Realty Income's business model. It is a net lease REIT, which means it owns single-tenant properties for which the tenant is responsible for most of the operating costs of the properties they occupy. That sounds like a great deal for the landlord and a terrible one for the tenant until you step back and look at the big picture. Effectively, Realty Income is providing capital to property owners. Using a sale-leaseback transaction, the property owners are taking a building that is sitting on their balance sheets, doing nothing, and turning it into cash that can be used to help fund growth or pay down debt. Realty Income is giving them a chance to extract value from that asset while allowing the new tenant to maintain a significant amount of control over the property. It's as close as a win-win as you can get. Realty Income, meanwhile, makes a difference between its cost of capital and the rent it charges, which is the vital piece of the story that he didn't think enough about. REITs have to hand over 90% of their taxable earnings, as I covered before, as dividends to shareholders. That doesn't leave a whole lot of cash left to invest in growth. Thus, REITs frequently sell stock so they can buy more assets. The dividend yield is a rough proxy for how much equity capital costs a REIT. The lower the yield, the cheaper equity capital is, and easier it is for a REIT to profitably grow its business. And as he indicates in this story, it's a mistake that he won't make again. He once again owns Realty Income because it bought another REIT that he has investment in, and he has no intention of selling, noting that the yield remains in the 4% range today. So that is one aspect that I'm looking into, is that it's very stable and it's a great way, even with what potentially could be coming with further downturn and or continued volatility through this year, to at least get some sort of assurance that you're going to get payback on your investment. And once again, this should be one that's in your portfolio for the long term to really start to build that passive income portfolio. As you can see here, the title of this next article in Motley Fool, Why Realty Income's Dividend Has Grown for More Than 25 Years. The key points: REITs are great dividend stocks by design. Realty Income's a blue chip REIT that pays shareholders each month. Understanding why Realty Income is successful is key to gauging the stock's future potential. And anytime that you hear that a company has paid out dividends for 25 years, they are considered a dividend aristocrat. And outside of that, dividend kings would be the next step at 50 years payout. So you know that if the company has been paying out for that long, there's a certain guarantee or security to being in that investment and making sure in the long run you're going to continue to build on your wealth. There are thousands of publicly traded stocks, but only a small portion have paid a dividend without interruption. Some eventually join the list of dividend aristocrats, those companies that have raised their dividend for 25 consecutive years or longer. Real estate investment trust Realty Income takes it a step further. Now, they're referred to as the monthly dividend company. Realty Income manages to pay a dividend every month of the year, something that not many dividend stocks can say. How does a company manage to keep shelling out cash to investors? Understanding the secret sauce behind Realty Income. Congress created this business structure to allow shareholders to invest in real estate without owning properties outright. They are great dividend stocks because they're required to pay out at least 90%. Now that's what we covered before, and if you go and do research on Warren Buffett, you'll see that he's not a big proponent of actually owning real estate. There's a lot of time and effort, which equals money, involved in real estate acquisition and management. And so this is another approach to being able to be diversified and have an investment in real estate without actually owning properties. REITs typically acquire a property and then rent it to a tenant under a lease agreement. These companies will pay for the real estate by issuing debt or new shares. Its weighted average cost of capital, WACC, is how much it costs the business to raise these funds. Here's when things get fun. Realty Income's balance sheet is rated firmly as investment grade by the major credit bureaus, carrying an A rating from Standard & Poor's. A strong credit rating fetches lower interest rates when taking on debt. Additionally, the stock's popularity among investors often gives the shares a higher valuation relative to its many peers. And if we compare this with Simon Property Group, using a ratio of share price to cash flow, you can see that a more expensive stock will raise funds more effectively when issuing new shares. And taking a look at this chart down below, you can see how that ratio compares between Realty Income and Simon Property Group. Cheap debt and expensive stock help produce a low 5.3% long-term WACC for Realty Income, which creates a significant advantage. REITs must create a gap or spread between the return on assets and the cost of capital. A higher cost of capital may require companies riskier tenants because it must charge more to create a spread. Realty Income can be pickier, acquiring higher quality tenants, as we saw at the beginning of this video, that qualify for lower rent terms because Realty Income has that lower cost of capital as a buffer. It can underprice many competitors while still generating profitable and safe cash flow streams. It also uses net leases in which tenants pay for property, maintenance, taxes, and insurance. Talked about this. Current dividend yield is just over 4%. It's actually been paying out and raised its payout for the last 26 years and running. And this is right in line at that 4% with the stock's long-term average, as you can see in this chart. So reinvesting dividends is also a great way to just continue to snowball and build on your portfolio and investments. Realty Income has averaged a total return of 10% annually since 1995, assuming you pocketed the dividends. But that annual return goes up to 15% if you reinvested those dividends instead, turning a $10,000 initial investment into more than $400,000. So really think about that and put it into perspective. That is a very long-term investment, and going in from 1995 to current day, you're almost at 30 years. But also think about that investment. If you started with $10,000 and continued to build on that in dollar cost average over the years, you'd probably be closer to double that 400,000, possibly even close to $1 million. So that's really what you have to put into perspective, is that you have to make these very long-term plays on these companies that have been around for a long time and are very stable. And I think that Realty Income is one of those companies that's going to continue to perform. So as always, I'm not an investment expert, nor am I licensed, but I would suggest that you do your research on this company. Go and seek out those sources about what this company really is about. Go to their website, read in the investor relations section on how they perform, and make your own decision. This was published last week in Market Watch. Realty Income Corp stock falls Thursday, underperforms the market. Now the shares of Realty Income, ticker symbol O, slipped 1.93% to $67.24 on Thursday. And this was an all-around rough trading session for the stock market in general. Realty Income closed $5.31 short of its 52-week high at $72.55, which the company achieved on January 13th. So you can see that there has been a slight downturn, but we will take a look at the chart as we go into the 5 years, 1 year, 6 month, and within the last week. So starting here with the 5-year chart, you can see that back in 2017, $58, we're currently at $67 per share. Now there has been dips along the way. I'm sure that it was impacted by times when we've had a cycle downturn with real estate in general. But you can see it's pumped all the way up to as much as $78 November 2019. And then as that Black Swan event hit, dropping down to $45. So it made a fairly decent climb, almost $20 per share since the pandemic impacts of March 2020. And like I said, if we go to the 1 year, we're still up 12.95% in the past year. And as I stated, just above that 4% dividend yield, 4.38%, which works out to about 25 cents per share. And so obviously with it paying out monthly, then as long as you're getting in on the ex-dividend dates, which means that you need to own shares before that date, which the last one for a payout in February was January 31st of this year. And so based on that, the next ex-dividend date will be the end of this month here in February. So this is one that even in the past 6 months, down 3.9%. And so there is some peaks and valleys, $62 all the way up to, like we said, $67 today, but even hitting $72 back in January 4th, 2022. So really what you want to think about is the long-term picture, drawing that average line of all the peaks and valleys, and knowing that over time it's continuing to go up and snowball your money and really build on your investment. Still down 5.87% in the last month and just under 1% for the past 5 days. So that was the big reason why I wanted to cover this company today. REITs are something that I'm starting to become more interested in to continue to diversify my portfolio. And I think it's one that you should look into as well. So I know there are other options out there for REITs. Definitely leave any comments below for our fellow investors and subscribers, followers of my channel. Let's continue to build on this YouTube community in 2022. I want to get to that next milestone of 250 subscribers. I'm at just under 150. And so pushing to that next milestone, I'm hoping will come relatively quickly. but it's with each and every one of you helping me out. Hitting that like button, sharing this with your friends, and subscribing and turning on that bell. So until next time, continue to look for opportunities to make that money, and don't just survive, thrive!